Last 2 weeks we were discussing how to price bonds for the fixed income securities. Last week we particularly discussed a special case. What is that?
Price and yield.
Price and
Yield.
yes, we discussed about price and yield relationship. Apart from that, about pricing, how to price a bond, we discuss a particular case. What is that?
So what is the dirty price and the clean price and how to calculate the accrued interest?
Sorry, I didn't get that.
The clean price and the dirty price, how to calculate?
Yeah, we discuss about clean price, dirty price, and how to calculate those prices. How do we calculate the dirty price?
That is a clean price plus accrued interest.
Clean price plus accrued interest. How do we calculate accrued interest?
Clean price plus dirty price.
So you are going around that equation. How do you calculate the accrued interest? How do you calculate clean price?
Dirty price minus accrued interest.
Okay, then if you have to calculate clean price as dirty price minus accrued interest, you should know what is dirty price and what is accrued interest. How do you calculate accrued interest and dirty price? You can use that equation to calculate one of them when the other two are given. That's okay, but I'm asking, how do you calculate those individually for the first time? Without knowing the accrued interest and the dirty price, you cannot calculate clean price. How do you calculate dirty price? How do you calculate accrued interest?
Present value of future cash flows, you can calculate the dirty price.
Yes, calculate basically simply dirty price is the present value of future cash flows. That's it. How do we calculate accrued interest?
Coupon date multiplied by the number of days.
Coupon date?
No, coupon amount.
Coupon amount
Multiplied by the dates, number of days which held until maturity.
Until maturity.
Yes, whatever dates that was kept.
How do we calculate the accrued interest?
The dates between the coupon date and settlement date, we get that.
Yes.
Multiplied by.
Accrued interest equals, you can say, coupon amount into, whenever we say coupon amount, that should be the coupon amount during that coupon period, or for that particular coupon period. What is the coupon that we are going to receive for that particular coupon period? Then what do we do? Multiply this by what do we do then? This is the coupon. coupon is multiplied by
Number of days.
number of days where
From the coupon date to settlement date.
number of days between
Settlement date and coupon date.
coupon date and the settlement date. Is that all?
Divided by the current coupon period.
What does it mean, current coupon period again?
Coupon frequency.
Coupon frequency.
Yes.
Number of days between coupon date and settlement date, divide by what?
Maturity dates.
Maturity date.
Number of days in current coupon period.
Number of days in current coupon
period.
period. Then how do you calculate the number of days between coupon date and settlement date? How do you calculate this part? Either you have to count manually or you can use an Excel spreadsheet to calculate this. So there was an answer saying that you divide by frequency, coupon frequency. You need that to calculate this C. What is that? How do you calculate the coupon? That is coupon rate into face value, this divide by frequency. So you can substitute that this part instead of this. This is the equation I have given to you. So but I explained, this is the coupon rate into face value divided by frequency, coupon frequency. You get the coupon amount for that, for a particular coupon period. So either you can straight away use that coupon amount or calculate it in adjusted for the number of days. So all these were discussed week before last week. So my question was, what we discussed last week? What are the topics that we discussed last week? This is the one we discussed last week. How do we price a bond between coupon dates? So if we calculate the price on a coupon date, we get its full coupon periods. So we can count time as 1, 2, 3, 4 likewise. But when it comes to in between coupon dates, the remaining maturity may not be exactly full coupon periods. There can be fractions. So that's what we discussed, how to calculate that fraction number of days in between the settlement date and the next coupon date. Remember, settlement date and the next coupon date. For accrued interest, what we need, last number of days between last coupon date and the settlement date. To calculate the price, what we need, settlement date, number of days between settlement date and the next coupon date. So then we decide the cash flows and timing of cash flows. So you can see now there are fractions, not full numbers. When we in the previous examples, we could see 1, 2, 3, 4 exactly integers, so full numbers in as timing of the cash flows. But in this case, it is not exactly full numbers or full coupon periods. There can be fractions like this. So then we use the same concept, calculate the present value of all those cash flows. In this instance only, you can see it two different price, like dirty price and clean price. If we price a bond on a coupon date, we get only the clean price. There's no dirty price because no accrued interest on that. It's being paid on that date. So, but when we price a bond in between coupon dates, there's a accrued interest component and subsidy in the future. So that's why we get that concept, dirty price. So if we follow this method, that fundamental equation to calculate the bond price in between coupon dates, the price that you get is the dirty price. Then to get the clean price, we need to know what is the accrued interest. First we have to calculate the accrued interest. Then we can get calculate clean price as the difference between dirty price and the accrued interest. That's what we discussed. Then after that, what we discussed, then we discussed the concept yield to maturity. So we discuss yield to maturity is the in a way of measuring rate of return if someone holds the bond until maturity. So, but to realize this yield, you have to not only hold this bond until maturity, whatever the future cash flows should be able to invest at the same rate until for the remaining maturity of the bond. So that's what we discussed last week. Then we discussed about the relationship between price and yield to maturity. We know when yield increases, price decreases. And I highlight, this is not the yield curve. Remember that this is not the yield curve. This is the relationship between price and yield to maturity. Then there's another simple way of measuring the return. We call it current yield. Current yield is the how do we calculate current yield is calculate coupon amount that we receive during a year and divide by the price that we pay to buy the bond. So for the price that we pay, what is the interest income that we earn? That's the ratio, that's the current yield. But thing is, in this measure, we don't account for capital gains or losses that we may get at the maturity. So that's the weakness of this current yield. Then we discuss about the yield curve. That's the term structure of interest rate. The yield curve is the relationship between time to maturity and yield. So for different time maturities, what are the yields? That is we call the yield curve. So this is an example of yield curve. On the x-axis, you can see different maturities: 1 month, 3 months, 6 months, likewise up to 15 years. And on the y-axis, you can see yield. What is the yield for 3 months maturity? What is the yield for 7-year maturity? So there can be different shapes of yield curves: normal, flat, inverted, and armed. In a normal yield curve, it's upward sloping with the maturity like this. This is almost a normal curve. When yield, time to maturity increases, yield also increases. This is a normal yield curve. There can be some yield curve flat. That means whatever the maturity, in a flat one, whatever the maturity, yield remains same. This is a flat yield curve. Or there can be yield curves when the maturity period increases, yield decreases, like this. Or it can be like this. However, when the time to maturity increases, yield decreases. So that is the inverted yield curve. In the humped one, there can be different shapes. It can be something like this, or it can be something like this. So what's happening here? From short term to medium term, interest rate increases. That means with the time to maturity, yield increases. Then in the beyond some point of time, when time to maturity increases, yield decreases. Or it can be other way. Initially, yield decreases with the time to maturity, then start to increase yield to maturity with the time. So these are the different shapes. There are theories of the yield curves. Why do we have this different type of yield curves, and what does it reflect? If time permits, we'll discuss a little bit on that. It's somewhat important when you are in the market to know that. So therefore, most probably, at least we'll discuss in brief, but it's mostly sort of economic lesson. Then we talk about the steepness. That means the slope of the yield curve, the difference between short-term yield and the long-term yield. If it is too high, then we call it a steep yield curve. Curve 1 and curve 2. So this is steep compared to this one. So this is relatively flat compared to this one. So the concept is a relative thing. Even in the red colored one, there's a steepness, there's a slope. But when we compare these two, this line is much steeper than this line. So that's the steepness. So then when we discuss about changing or shifts in the yield curve, one is parallel shift. That means for each and every time to maturity, yield increases or decreases by the same amount. So the curve shift upward or downward exactly by exactly same amount. So they are the old yield curve and the new yield curve are two parallel lines. But in the non-parallel shift, yield changes in different maturities by different amounts. So based on that non-parallel shifts, there can be twist in the slope. That means the first yield curve is like this, then it can become like this. So it's a twist in the yield curve. While short-term interest increases, long-term interest decreases. Or it can be so. If the curve was like this, next one could be something like this. Yield increases, short-term and long-term yield increases by large amounts compared to the mid of the time period. So all those different shapes or the changes can happen. Based on this, we in the change in the harmonious, there are two different patterns or the names given: positive butterfly or the negative butterfly. So we discussed all those things last week, and I explained the most common two types of shifts are a downward shift in the yield curve with a steepening of the yield curve. That means when the yield drops, short-term yield drops drastically than the long-term yield. So the yield curve becomes more steeper, but with a shift to the downward. Or if the yield curve shifts upward, then it would be a flattening. That means short-term interest increases more than long-term interest, something like this. So if we consider this is the first curve and this is the second curve, that means new one. Then you can see this is the downward shift. This is not in a downward shift, it could happen other way around. This is the first yield curve. Downward shift is happening. What would happen? Short-term interest will drop drastically while long-term interest drops only by a small amount. Then the new yield curve would be something like this. So the curve has shifted downward, but the slope has increased. It has become more steep. Or the other way around, when it goes up, in that instance, this is the first yield curve, this is the second yield curve. Short-term yield has increased by large amount, but long-term interest has increased only by short or a small amount. So then the curve flattens. So those are the mostly common observed changes. And the other observation is short-term yields are more volatile than the long-term interest rates. So that's what we discussed last week. This is the main topic that we are going to discuss today. Risk and return characteristics of fixed income securities. Today we are mostly focused on the interest rate risk, and this is the risk, interest rate risk, and how do we measure it? The measure is the duration. So today we are going to discuss this. How do we calculate duration and how do we interpret that? How do we use to predict future values of a particular bond or a bond portfolio? So that would be the focus today. Okay, first, what is interest rate risk? So we learned the price of a bond and the yield to maturity there's a inverse relationship. Price decrease when yield to maturity increases. We learned that. So what is the risk then? If interest rate increases, our price decreases. The value of your asset decreases. So that's the risk. That is we call interest rate risk. Due to changes in interest rates, value of the bond that we are holding will change. That is the interest rate risk. So we are going to measure that sensitivity through a parameter called duration. We'll discuss how to measure or how to calculate duration and how do we interpret it. Here it's given, but we'll discuss more in the in detail later. So I'll skip this because we are going to discuss this in detail. Other than interest rate risk, in fixed income securities, we face these risks. Credit risk. What is that? Is the issuer of the bond, fixed income security, may not pay back whatever the promised cash flow. That can happen. It may be a coupon payment or it may be the maturity proceeds. So for whatever the reason, the borrower or the issuer may not be able to pay it back. So that is the credit risk that we face from the issuer. Slight variation that we may face through the counterparty, especially when you are dealing in the secondary market. because in the secondary market, the transaction is take place between two parties in the market, nothing to do with the issue. We don't do trade with the issuer in the secondary market. We do trade in between parties in the market. So we know there's a time difference between the trade date and the settlement date. What is trade date? The date that you come to an agreement to do a transaction. What is the settlement date or the value date? On which date you exchange your obligations. That means the buyer pays cash, transfer funds, and the seller transfer the bonds. So one of these counterparties may not honor that. There's that risk. So buyer may not pay cash, or the seller may not deliver bonds. So that is the counterparty risk. But to minimize that, in most of the bond markets, this concept, delivery versus payment concept, is used. What is delivery versus payment?
Cash flow and the security movement.
Yes, cash flow and the security movement. If you can.
Yeah. In basic terms, if it is a delivery versus payment, it refers to the inventory delivery from one end to another, and against that we receive a payment.
Yes. So be more specific. So these things will be settled through a clearing house, or in our case, in Sri Lankan market, central depository system and RTGS maintaining within Lanka settle. Yes. So, however, what happens? Buyer has to deliver cash to that clearing house. Seller has to deliver bonds to the clearing house. Then only the clearing house exchange the ownership. Then the clearing house will transfer funds from the buyer to the seller. Meantime, simultaneously, bonds will be transferred from the seller's account to buyer's account. If one of the parties fails to deliver, then the transaction will not take place. Funds will not flow through. If the buyer has delivered funds but the seller has not delivered bonds, then the fund transfer would not happen. Funds will still remain with the buyer's account. If the seller has delivered security, but the buyer has not delivered cash or the required funds, then the ownership of the securities will not transfer to the buyer. It will remains with the seller. That is DVP. You have to deliver before you get the payment, or you have to deliver the payment before you get the delivery of the bond. So that is the mechanism. So in this case, you don't lose your principal amount, but there can be a small opportunity cost. If the transaction is not settled, then you have to go back to the market and do another transaction to fulfill your requirement. By that time, market might have moved against you. Most of the case that would happen, depending on the party who is defaulting, because it may not be only to you, it may be to other parties in the market as well. Then there can be a market panic, things like that. So most probably the market will move against you. So however, that risk is minimized through delivery versus payment. Then the liquidity risk. Did we discuss liquidity risk? There are two types of liquidity risk. Have you discussed this? Liquidity risk. One is funding liquidity. Other one is trading liquidity. What's the difference? What's the difference between funding liquidity and trading liquidity? Basically, liquidity risk means from your side, you may not be able to honor your obligation. You don't have enough cash. You have a lot of assets in your possession, maybe buildings, government securities, or whatever, but you don't have cash to meet your obligation. You have to pay for customers, depositors. They are going to withdraw their deposits, so you need cash. So you have some commitments for other banks to pay whatever the borrowings from those banks, things like that. If you don't have cash, or you cannot convert whatever assets quickly into cash form and honor that obligation, then you are facing, that's the liquidity risk, inability to meet your obligation. So that liquidity requirement can be fulfilled through two ways. One is funding. If you can borrow from another party quickly and adequate amounts, then you are liquid. So you can borrow quickly and honor your obligation. So that is funding. What is trading? Whatever the assets, you should be able to quickly convert into cash. That ability is the trading liquidity. So the risk is funding liquidity risk means you are not in a position to borrow from the market at any cost. In an emergency, you don't worry about the cost. You may have to borrow unless otherwise you are failed. You are going to default. So you want to avoid that situation. So therefore, whatever the cost, you are willing to buy, but there's no one in the market to lend you. That can happen. So that is the funding liquidity risk. Trading liquidity risk is whenever you try to trade a security or whatever assets, value of that asset change drastically against you. So you may not be able to liquidate your positions quickly and get a good or the fair price. That is trading liquidity. So when you make investments in the whatever the asset, especially here we are discussing about fixed income securities. When you buy a security, you forego your liquidity because you give your cash to the borrower for a longer period, you get a security. So you forego your liquidity. So therefore, in future, you may face a liquidity risk. You may not be able to meet your obligation. But if that security is very liquid, that means you can sell it in the market very quickly. You can sell that security in the secondary market and generate cash, whatever you need. If that security is not that liquid in the market, then you face the liquidity risk. And the other one is the reinvestment risk. What is the reinvestment risk? What do you have to reinvest? That's the first thing. What do you have to reinvest?
That is coupon payments, no, sir?
Yeah. We get coupon payments on regular intervals. As I mentioned earlier, if you want to realize your yield to maturity at the time, the yield to maturity which was there at the time of purchase the bond, you should be able to reinvest the coupon receipts at the same rate. But by that time, interest rate might have moved against you. Now the interest rate are much lower than the yield to maturity prevail in the market at the time of purchase. So you face that reinvestment risk. Clear? Then the call risk and put risk. What is call risk? If you remember, I explained you a bond type called callable bond. What is a callable bond? What is a callable bond? The issuer can repay the bond before the original maturity date. But there may be a schedule. Most probably there's a schedule which is agreed upon at the time of issuance. Before the maturity, issuer can redeem the bond. Basically, it will be at most of the time, it will be at the market price or maybe at a lower price than that, because there's a call price, call schedule on which date that the issuer can call it and what is the price. So what do you expect? In which kind of scenario the issuer will repay the bond without keep it until maturity? If you are a borrower, at what sort of circumstances will you pay your debt early?
That one scenario is that issuer has enough liquidity. And then other scenario is that issuer is in a position to raise the money at lower cost than the issued interest rate in the market.
Yes. So even in the first scenario, even if the issuer has enough liquidity, would he pay back his loan early if the current interest rate is much higher than that, higher than the cost of his borrowing?
If that issuer doesn't have any opportunities to use that excess liquidity, that might be happen.
That might happen if there's no, but basically he can invest it somewhere. If he can invest at a higher rate, he won't pay back the his obligation. However, the second scenario is that's what happened exactly. When the market interest rate is much lower than the cost of borrowing of this particular bond, the borrower can borrow new funds at a lower rate and repay this debt. So most of the time bonds are called, or the only callable bonds in this scenario. So is it a good time for an investor to get money early, or is it a bad time?
It's a bad time.
It's a bad time because he gets an unexpected cash flow, whereas the interest rates are low. So he has to reinvest that cash flows at a lower rate. So that's the call risk from investors' point of view. Put risk is with the basically with the issuer, because what is the puttable bond? the buyers can ask the issuer to prepay or redeem the bond before maturity. So buyers will do that, or the investors will do that when the interest rate are high. So that is a disadvantage for the issuer. Issuer may have to raise funds at a higher rate and pay back the investors. So that is the call risk and the put risk. Clear? Any questions?
Can you explain the DVP?
Sorry, I cannot hear you.
Can you explain the DVP?
DVP, yes. Say, so let me put it into this way. If you go to a boutique or a shop, if you want to buy something, what do you do? At the time you purchase something, you pay cash on one hand and you receive your goods on the other hand. At the same time, you pay and you get. So delivery means the seller deliver you goods, you pay cash. That is DVP. Both happens at the same time. So what are the instances which we settle transaction in different ways? Sometimes you may have to pay cash first and wait until they deliver your goods or service. It's not taking place simultaneously. Payment of cash or transferring funds and receiving goods or service may happen in two different time periods. In the DVP, both happens at the same time. So if you exactly speaking, what is DVP? Bonds are settled through a clearing house. So both parties have to maintain accounts with clearing house. Buyer pays cash to the clearing house. Seller deliver securities to the clearing house. Then clearing house check whether buyer has delivered cash and whether seller has delivered securities. If both are present only, they transfer the ownership. Transfer money from buyer's account to seller's account, simultaneously transferring securities from seller's account to buyer's account. That is DVP. Is it clear now?
How that becomes a risk rate? That does not happen.
Sorry?
How that becomes a credit risk?
How does that happen? A credit risk? No. No, I mean the risk is there. It has mitigated through DVP. So therefore, if securities are settled through a DVP basis, there's no counterparty risk now. The risk is there. It is mitigated through this DVP mechanism.
In Sri Lanka, how do you check that?
Because you settle funds through the RTGS in government bonds, and the securities ownership is handled in the scriptless securities settlement system, SSSS. So they coordinate each other. They check whether when CDS receives SSS receives settlement instructions, it sends a message to RTGS and see whether there's adequate funds. If the funds available, they block that funds, come back to the CDS, check whether the securities balances are available, then lock that securities, then transfer funds once the fund transfer is completed, get the message to SSS, then securities are transferred from that blocked securities are transferred to the buyer's account. So that's what happened. When SSS or SSS check availability of funds, if the funds are not available in that particular account, the process will stop at that point and not settlement is failed. Then the necessary messages will be passed to the relevant parties saying that the trade is failed. First instance, indeed, whenever the instructions is received by the SSS, they check whether the securities are available. If the securities are not available, then again the same thing. First check whether securities are available, then check the funds are available. If available, both are locked, and once it confirms that funds and the securities are available in the respective accounts, then only they transfer funds and then securities. That's how we have.
Who checks that those things publicly will be found?
Sorry?
Who checks that these funds are available and securities are available?
That's through the system SSS.
The SSS stands for what?
Scriptless Securities Settlement System.
Okay, thank you.
So this happens on the settlement date itself, or do we have to like
On the settlement date.
Okay, so the fund transfer will have to happen on the settlement date, right? Not before, is it?
Not before, yes.
Okay.
So are there instances where that checking has not happened and the transfer has happened but the money is not delivered?
No, it won't happen. If the securities are not there, either securities or the funds not available, then the trade fails.
Okay.
Anything else? Any other question? If not, shall we move to the other topic? So yes.
So in counterparty, it happens in secondary market, no? Not in the primary market.
Yes. Even in the primary market, so there's a risk of settling between central bank or the public debt department and the bidders, primary dealers. Even that is settled through the DVP basis. Still that risk is there, but once you purchase, so from market participant point of view, you cannot expect the borrower to default at the time of borrowing. Borrower will deliver securities, so it's the issuance. Only concern is from central bank or side or the borrower's point of view, government point of view, whether the primary dealer will not deliver funds. So without receiving funds, the central bank or the public debt department will not assign securities to the primary dealer. Anything else? If not, shall we start this topic? So basically this is about interest rate risk. So what is the sensitivity of a bond for a change in given interest rate, and how do we measure that impact? What would be our new price if interest rate changes? So duration and convexity are the two basic risk measures that we use to measure the interest rate risk. So you might remember this. How do we price a bond? This is what we discussed. It is the present value of future cash flow. C1, C2, C3, Cn are the coupon payments. F is the face value. So we discount each at our required rate of return or the at yield to maturity. Then we get the price. So this is just to remind you, because everything will be based on this equation. So then you might remember we discussed this price yield curve relationship. This is the graph we did last week. So for a particular bond, yield to maturity, when yield to maturity increases, price you can see it's decreasing from 220 to 60 or 50, 40 something when the interest rate is 10%. So basically, when yield to maturity increases, going this way, price going this way, price decreases. Now you can see this is not a the price change is not the same in or at each yield to maturity. Say 1 to 2%. At 1% price is 200 something. 2% it's around 160. More than 40 rupees or $40 drop. But if you see 7 to 8%, 7% price is somewhere in between 70 and 80. When it comes to 80%, it's just about 60%. Sorry, 60 rupees here. So from 7 to 8% price decrease, yield increase, price decrease only by or less than, however it's less than 20 rupees. But in this 1% to 20%, it was about 40 rupees. So you can see for even the interest rate changes by the same amount, price changes by different amounts. At different yield to maturity, the sensitivity of yield, interest rate, sensitivity of price to a change in interest rate is different. So that depends on this curvature as well. So we are going to discuss how to measure that sensitivity and how do we, basically how do we measure it and how do we make the adjustment. So again, these three graphs we did last week. You can remember for three bonds, bond A and A, B and C. Same coupon 5%, same coupon frequency but different maturities. You can see the slope is high, or the change in price is high for the bond A. What's the reason? Bond A has a longer maturity. But bond C, it's like almost a straight line. It's almost a straight line, and it has the shortest maturity. So maturity, there's a impact on this shape of the yield and price. Not only maturity, I think we did the same exercise for different coupon rates. Then you saw that what is happening. So we are going to measure these things. So we'll do a small exercise. 4 bonds, bond A, bond B, bond C, and bond D. Bond A and B have the same maturity, 5 years. C and D has the same maturity, 8 years. But coupon wise, bond A, 0 coupon, bond B having 4% coupon, bond C again 4% coupon, bond D 6% coupon. Can you calculate the price of these 4 bonds when the yield to maturity is 5% and when it is at 5.25%? Calculate the prices of these 4 bonds at these 2 different yield to maturities, then calculate the price change as a percentage. Can you do it now? I'll give you about 15 minutes. Now the time is 9:40. I'll give you just 15 minutes until 9:55. You can complete it and let me know the answers. Any question? This is nothing new. You can do this because how to calculate the price we have discussed.
Yeah, so I use the Excel formula and I have the answers.
Here are the answers. What about others?
I didn't do it manually.
Sorry?
I didn't do like the manual work. I just use Excel. So
No, it's okay. Yes, at this time, I think that's the best way and easiest way. You use the Excel function or you use Excel
yeah, function, the price.
price function. Others, what about? Even you do a manual by a small calculator to calculate the price of the bond A, it won't take 1 minute. This is a very straightforward calculation. It won't take time, but these are just these take some time if you do it manually. But still, if you have a piece of paper and note down the cash flows and timing and the equation, then it's just a matter of keying into a calculator. It won't take long time. Okay, shall we see the answers? Can I have the answers? What is price here?
So that one I have 78.35.
78.35. Okay. at 5.25,
77.43.
77.43. Bond B,
It's 95.67
95.67.
and 94.63.
Bond C,
93.54
93.54.
and 92.
92. Bond D,
106.46
mm,
and 104.8.
okay. At least you should see some pattern. This is a zero coupon bond, so therefore it should be at a, and the maturity is 5 years. It should be at a considerable discount. So that's why you get 78 and 77, something like that. And the other thing is, for each bond, the price at 5%, or in this row, should be higher than the prices at 5.25. So you should be able to see that pattern. And the other thing, when the time to maturity increases, other than this zero coupon bond, what should be the prices? Indeed, these two, what is the relationship that you should see? Same coupon, 5-year maturity and 8-year maturity. What is the relationship? Should
Decreasing, right?
decrease. Yes, there should be a price decrease. Then this is again what you can see.
Increase.
Coupon, yes. Why? What's the reason? The coupon is 6%, whereas the yield to maturity is 5.5, less than the coupon. So you should get a premium price more than 100 prices. So you should have that sense and have some assessment of the correct on your answers, whether it's correct. It may not, but at least you can check whether that's correct. Okay, however, yes, these are the answers. I can presented it here for 4 decimal places. As I mentioned earlier, don't try to chop it for 2 decimal places, because there's a value. If you multiply this by million or billions, ultimate price change may be thousands or 100,000s. So these are the price change. Did you get these figures as well? Or
Yes,
if
sir.
you have not
Yeah,
if you have not got this, we'll discuss.
no, I didn't get that figure.
Other
Price change.
others,
Yes, sir. Okay.
yeah, okay. So basically, as I mentioned, you should do things. Then it's good for you. It will remember, and you get to know the concepts just by looking at this or noting down these numbers. You won't get anything. Do it by yourself, then you will get to know more things. However, today's our concern is on this price change. You can yield change, 0.25% yield change. Different bonds reacted in different manner. The zero coupon 5-year bond is price is dropped by 1.18%. So this is a zero coupon bond. So therefore we expect large price changes. That's fine. But if we take these, okay, what is the difference between A and B, bonds A and B? What is the difference between bond A and B?
The coupon.
There's one is zero coupon bond, other one is a zero coupon bond. Now you can see price sensitivity is high in the zero coupon bond. For a given change in interest rate, price will change by a large amount in a zero coupon bond than a coupon bond. You can try with even 1% coupon. The price change would be less than 1.1. So that's one observation. Then if we compare bond B and C, what's the difference?
Duration.
What do you mean?
Maturity, yes.
Maturity. So bond B has a 5-year maturity, whereas bond C has a 8-year maturity. So longer the duration, longer the maturity, more the sensitivity, higher the sensitivity, because the coupons are the same. Then when you compare bond C and D, same maturity, the difference is coupon. Again, the same relationship as in the zero coupon and a coupon bond. When coupon increases, sensitivity decreases. So remember that. Yes.
How do we calculate that zero coupon bond price?
How do we calculate the zero coupon bond price? Use the same concept. What are the cash flows? What is the price present value? What are the cash flows for a zero coupon bond?
Only the face value has to be discounted.
Yes. How do you get this one price at 5%? What is the cash flow? How many cash flows in a zero coupon bond?
One cash flow.
Huh?
One cash flow. Discount.
One cash flow. One cash flow. What is the cash flow? Face value. So what's the face value here? It's 100. Then what do you have to do? Discount it. 1.05. But for how long? For
5 years.
5 years to the power 5. That's it. So that's why I mentioned that it won't take a minute. Straight away you can key it into a calculator. 100 divided by 1.05 to the power 5.
But others take time.
But
Others take time. The zero coupon is okay.
others takes a little bit time, but still I think that's what even you take a piece of paper and write down cash flows, only 5 cash flows here, only 8 cash flows here in all these. Just key it into a calculator. The thing is, you don't know how to key it into a calculator in one go. You try to do a one by one. So first cash flow discount by 1 period of time, then note it down. And the second one, that's one way. And the other thing is, you forgot about the simple equation that you can use. What is that? With the
Annuity, sir.
annuity equation. It won't take long time. So you have to remember all those things. Okay, any question? Anything else? Anything else? If not, forward. So how do we measure this sensitivity? That without doing this for each and every yield change, without doing the price, new price and calculating the change, there's a way. So first measure, we call it as Macaulay duration. The name Macaulay comes due to the person that who found this. So that's why we call it Macaulay duration. So it's nothing but it's the weighted average time. It's a weighted average time. So it's not average time, it's weighted. So we weight the time by the present value of the cash flows. So if we go back to this equation, you could see this one, you can write it as 1 into C1. What is this one? That is the time. This 2, time. N is timing. N is timing. You can see all others are almost same as the pricing equation, other than this 1 over P part and this 3, 4 like timing fact. So this is the time. This is also time. This is also time. What they have done, for each time we have weighted that by this part. What is this part? What is this? Can someone identify what is this? Cash flow divided by 1 plus y over k. What is this? Second
The
cash.
present value, sir.
These are the present values. Exactly. Why this k is there? This y is yield to maturity. K is, what is k?
Compound time number.
Coupon
Frequency.
used as f, because we don't use YTM as it is in the pricing equation. If the coupon frequency is different from 1 year, then we have to divide that yield to maturity by the frequency. So all these are present value of the cash flow. So we weight this time, and once we add all these present values, what do we get? Price. So the present value divided by price, that is the weight. So for all time periods, we have taken weighted average. Time multiplied by weight. Time multiplied by weight. Weight is the present value of the cash flow. So then what we get, it's a weighted average time until we receive a bonds cash flow. So practical sense, still it won't give you that much sense, because say if we calculate a duration and it says duration is 3 years, you cannot expect to receive all the cash flow by 3 years. It won't happen. This is another way that you looked into that. The duration is the fulcrum point of the cash flows, balancing point. So even though it says cash flows, it should be present value of cash flows. So at this point, it balance. This is the weighted average time that will take you to get the cash flow in terms of present value. So basically, what does it say? If this duration is okay, this is another way of presenting. I did the calculation for a 10-year 5% annual coupon bond at yield to maturity 5.25. What would be the duration? So it is somewhere here. So that's the balancing point of these cash flows. These are the contribution given to this. These are the weights. So you can see the bulk of weight coming from the maturity, on the maturity date, from the face value. So if the coupons are high, what would happen to these cash flows or these weights? If the coupons are high, what would happen to these coupons?
The balancing point might move left to it, right?
Balancing point might move to
Left.
Left. Why?
Because
These cash flows would be high. Therefore, the present value would be high. Therefore, the weight given to the first cash flow, second cash flow, third cash flow would be relatively higher than these figures. If I increase that 5% to 10%, this would be much higher. So then, to balance this point should move to left, as you said. But what would happen if we increase the maturity? This cash flow would fall in, or this weight would be at a far into the right. So the weight move further to the right. So therefore, in that instance,
The balancing point
this
would
would move to right. So that is the concept or the idea that we should get. So therefore,
So why would you need such a concept?
so this we'll come to that. You can gauge how sensitive the bond to a change in interest rate.
Okay.
So this is the third point. The duration depends on the yield as well, not only maturity, not only coupon, and the yield as well. Before we move into this, we'll see how to calculate that duration based on this equation. We'll move to Excel. Example of 1 million face value. This one, 5% coupon. To make it easy, I made the frequency 1, annual coupon, maturity 10 years. So as we did in pricing, we need timing of each cash flows and the cash flow. So since the coupon is 5%, face value 1 million, we get 50,000 in each coupon date. On the maturity date, we get 1,050,000. Then what we have to do, if we go back to the equation, we need the price. And we need the present value of each cash flow as well. So we'll calculate that. Even to calculate the price, we need the present value. So this is the, as we did in previously, to calculate the price, cash flow, discount at the yield to maturity for a 1 period. In the second one, cash flow discounted at this yield to maturity and for a 2 time period. Likewise, we calculate the present value. When we add them up, what we get? This is the price. Then what we need? We have the price, we have the present value of each cash flow, but then what do we have to do? Multiply that present value of the cash flow by the time into present value of cash, present value of that cash flow, likewise. So in this column, I added the new, I added this column because when we calculate the price, we had only these 3 columns, you may remember. But this is an addition to calculate the duration. So time into present value. If you go to this one, time into present value, and add them together, we get this figure, the answer for this part. But the Macaulay duration is this sum divided by price. So I calculate this. So it came at 8.0867, the Macaulay duration. That means the balancing point is somewhere closer to 8 years. And these are the weights or the contribution as a percentage of the price. So the present value as a percentage of the price to this price, 4.84% is contributed from the first cash flow. The second cash flow only 4.6. You can see with the time the contribution decreases but suddenly increase at the maturity. So what we can see here, when the coupon increases, this duration decreases. We can see if we increase coupon to 8%, you can see duration decreases to, Macaulay duration decreases to 7.5. If I put it here 2%, it will go closer to 9. What would happen if we change yield to maturity? when the yield to maturity is 5.25, duration is 8. If I put it 8%, it is 7.78. When yield yield increases, duration decreases. Why? Now you can see earlier the contribution of the first cash flow was only 4 point something. Now it's almost 6%. The first cash flow gives a higher weight. But what would happen if we decrease yield to maturity, say, for 2%? Duration increases to 8.29, and you can see contribution from these cash flows decreases. So this gives us a measure how change or sensitive to a change in interest rate. So this is how do we calculate the duration? I'll put this at 5.25 as it is. So duration gives you a sensitivity of to the interest rate, and you can see how the duration changes with the change in yield to maturity and change in coupon. If you want to see how does it change with the maturity, then we have to do another calculation. I'm not going to do that now. However, the relationship is like this. Maturity, the longer the maturity, higher the duration. That means higher the sensitivity. When the duration is high, bond is more sensitive to the change in interest rate. If interest rate changes by a very small amount, price changes by a higher amount. If the maturity, if the duration is high. Duration high means the sensitivity is high. Duration is high when the maturity is longer. Then coupon, it's other way around. When the coupon is high, you have lot of cash flows or the high cash flows compared to lower coupon bond. So therefore the duration is low. Then the sensitivity is low. For a given interest rate change, price would change by a small amount. In the yield, when the yield increases, again duration decreases. So for a given bond, when the yield is high, yield to maturity is high, the sensitivity of the bond for a given change in interest rate is low. So you can see it in this example. You can see now you might get an idea. From 1% to 2%, price change is drastic. This is the price change. But at the higher yield to maturities, the price change is small. So this sensitivity is measured through duration. So that's how we use duration as a measure of interest rate sensitivity. Higher the duration of a bond, that means that bond is highly sensitive to interest rate changes. If the duration is low, that bond is less sensitive to the interest rate. But even that would change depending on what is the yield to maturity at a particular time. When the yield to maturity is low, sensitivity of price to interest rate is high. When the interest rates are high, sensitivity is low. So basically, remember, duration measures the sensitivity of a bond price to the interest rate changes. When the duration is high, sensitivity high. So therefore, for a given interest rate change, price change is high. Then the thing is, duration will change based on the maturity, based on the coupon and the yield. When the maturity is high, duration is high, coupon is high, duration is low, yield high, duration is low. That means sensitivity is low. So these are the key relationships between duration and maturity, duration and coupon, and duration and yield. But how do you interpret duration? It is the sensitivity of bond price for a given change in interest rate. In a moment, I'll show you what is this duration in much more practical way. How do we interpret? For that, we define another version of duration. We call it the modified duration. Modified duration. So because we do Macaulay duration, we calculate in this way. This MACD is the Macaulay duration, and it is divided by 1 plus y over k. Again, y is yield to maturity. K is the coupon frequency. Here we put this minus sign y, because when the interest rate changes, price change in the opposite direction. Just to reflect that, we have this minus sign. You know, here when interest rate or the yield to maturity increases, price decrease. So in this modified duration equation, this minus sign indicates that yield and price changes in two different or the opposite directions. Now, the interpretation of modified duration is easy and have some sense. In the duration, we just said it's the time weighted average of time. It's a weighted average of time. You won't feel anything, most probably. When it says weighted average of time, what is it? Until receipt of a bond's cash flow. Still, we don't receive by this. In this example, by 8 years, we don't receive the whole cash flow, even in the present value terms or the absolute terms. So, but when it comes to modified duration, it has a specific interpretation and which is more sensible. What it says, this modified duration measures the change in price, percentage change in price. Remember, it's not just change in price, it's the percentage change in price for a 1% change in yield. If the yield changed by 1%, what is the expected percentage change in price? That is given by or measured by modified duration. Is it clear? So I think now you are okay with this. Don't worry too much about the Macaulay duration. How do you interpret? Just remember, when the duration is high, price sensitivity is high in the duration. But when it comes to modified duration, we can give a precise interpretation in which we say for a 1% change in yield, what is the percentage change in price? So if we go back to this example, this 1.18% is only for 0.25% interest rate change. But if we change the interest rate from 5% to 6%, whatever the percentage change figure we get here, that would be the modified duration. Not this one is modified duration, but at 6%, what is the price here and what is the price change? That would be the modified duration. For a 1% change in interest rate, what is the percentage change in price? That is measured through modified duration. Again, if the modified duration is high, sensitivity is high. Percentage change in the price would be high. Any questions? Before we move into how to calculate modified duration. So basically, you have to remember this equation to calculate the Macaulay duration. Then from Macaulay duration to modified duration, you need this equation. And this interpretation. This is important. How to interpret the modified duration. So you can see when the yield is very small, then 1 plus something would be almost 1. Then there won't be any difference between modified duration and Macaulay duration. So therefore, even duration we can consider as the percentage change. If when we say duration is 8, we can consider it as approximately for a 1% change in yield, bond price would be changed by 8%. So therefore, even duration you can use it as a percentage, but precisely it would be the modified duration. You can calculate modified Macaulay duration and modified duration at different yields. You can see there's not that big difference, especially when the yields are very low. Any question? I'll give you a graphical interpretation of this as well. Before we move into that, is there any question?
In Macaulay's duration, are there any rationale that we multiply the present value based on the cash flow number? If you go back to that calculation.
Present value.
In your Excel, there in column F, based on the equation,
T into PV. Why this?
Is there a rationale?
Yes, this is the definition. So you can see 2 in the price. Remember, in the price equation, there's no 1, 2, 3, something like this. The numerator, because this is time and weighted by the present value. That's what we do. Weighted average time. When we say weighted average time, we have to weight time by something else. The weight is the present value of the cash flow. So in this one, there's a one here. One is the timing. This present value part is the weight. You get the weight because this present value divided by price, that's the weight. Did you get it? So in this graph, these are the weights: 4.84, 4.6, 4.3, 4.15. These are the weights because in Excel you can see this present value divided by price. Something wrong here. So these are the weights. You can get the same figure here if you multiply. Now this is the weight, 1 by this weight, and add them together. You can get that. You get the same figure. What I did, multiply this figure by this by this, and add them together. But instead of doing that, what I did here in the previously, calculate the present value, then present value times period. So then you get in this equation this part, time into present value of the cash flow, time into present value of the cash flow. So each cell represents each component of that equation, and ultimately that sum is divided by the price here. This is the sum, this is the price. Is it clear now?
Okay. We divide it by the
price.
The sum by the price and arrive at the center point, no?
Yes, we arrived at fulcrum point. This one. Sorry, it's not here. We derive this point.
Okay, Mr.
And this gives a sensitivity of interest rate, sensitivity of bond price to the interest rate change. So Macaulay duration, we don't specifically say it has a percentage change, but when we calculate the modified duration, we can interpret as for a 1% change in yield, the bond price would change by 7.68%. So if you in 809290, this is the price at when the yield is 5.25. Shall we do 6.25? And what is the price? 9078.86. What is the percentage change? It's 1. So it comes as 7.32. Can you see? Modified duration is 7.53. Actual change is 7.325%. So that's why it says modified duration gives you an approximate percentage change. It won't give you exact change, but it will give you an approximate change.
change in yield is always referred to as increase of yield. Is it?
Not necessarily.
Not necessarily.
It can be the
Even
change.
if you decrease,
That's why.
decrease.
Yes, that's why it says change in yield. Even if you decrease it, you should get very closer to.
Okay.
But
Still
the thing is, to make it very precise, we should not increase and decrease for a single side. It should be the current yield 5.25 is make it middle point, increase 50 basis point and decrease 50 basis point. Take that decision, take that difference. That will give you much more precise answer. For the reason, I'll explain that. First, let me finish how to calculate modified duration. So we did this part up to this to calculate the Macaulay duration.
Small thing, Nishantha.
Yes.
Now, Macaulay duration is 8.0867. No? So, as is directly referring to the 10-year bond, the weighted average is 8.08. So, roughly more than 8 years.
Yes.
That's why it refers, no? So, if it is a, let's say, if it is a 15-year maturity bond, it could be 13 point something. So, that refers to the 15-year comparison.
Yes.
I'm just telling.
Yes. Depending on the maturity, duration changes.
Yeah, this duration is
not only maturity. What is the yield that you are considering? What is the coupon of that bond? Everything factors into this.
In other words, the weighted average point will be for in this scenario for a 10-year bond. 10-year bond, the weighted average is coming to just more than 8 years.
Yes.
The center point.
Yes, but it can much closer to 10 depending on the coupon. If we decrease this coupon to say 1%, you can see it would be 9.4.
Yeah. So those are the dependency variables.
Yes, coupon, maturity, and at
yield.
which point yield. At which point we measure this. Those are the variables, factors that affect the duration. So that's why I explained higher the maturity, higher the duration. Higher the coupon, lower the yield, lower the duration. And duration measures the sensitivity of price for a change in interest rate. Okay. So we calculate the Macaulay duration. Once we calculate the Macaulay duration, to calculate the modified duration, what we have to do, divide this Macaulay duration by 1 plus y. In this instance, since the coupon frequency is 1, it is just 1 plus y, 1 plus D7. D7 is the yield to maturity. If it was semi-annual, we need to divide it by 2. But since it's an annual coupon, not necessary. So modified duration comes as 7.68 when the yield is 5.25 and the coupon is 5%. So what does it mean? If the interest rate changes by 1%, the price of this bond will change by approximately by 7.7%.
The reason that you are
1%, price will change by 7.7% approximately.
So the on the denominator, that's why you're adding as 1 plus, no, to arrive at the yield basis point of 1.
No. It's not the case.
It's not the case.
No, it's not the case.
That is also then again.
Yes,
that is also then again the equation.
Yes, that's the equation. There's a reason. I didn't go to that. So basically, okay, let move to that. Basically, what duration measures is, if you take this graph and if you calculate the duration at say at 5%, what is the slope of this curve? This should be a straight line. Sorry. Okay, no, I have it. Let me go. So at this point, what is the slope of this curve? You know what is slope.
Yeah.
So, but you can see, since this is not a straight line, at different points, the slope is different. What we do at a particular point, that what at the given yield, what is the slope? That is duration. So to get the duration equation, or the modified duration equation, what do we have to do is, if you know mathematics, we get that, or we get the slope of any curve. You have to take the first derivative. Those who have knowledge on mathematics, you know what is the derivative. Take the first derivative of the equation and express it as a percentage of the price. That then it comes to this equation, again divide by 1 plus y over k. That's why modified duration is defined as this. There's a reason for this 1 plus y over k. And the reason is, here what we measure, the slope of this curve at any particular point of time. So what is the slope of this curve at this point at 5%? What is the slope of this curve at 5.5? What is the slope of this point at 2.5? So that's the duration at this point. It gives you the sensitivity. Then you know what, if the yield is changed by this amount, what would be the new price. But again, let me explain here. If we measure the duration at this point, and the price would be, sorry, at this point, yield y1, price is p1. When we use the duration to forecast for a given change in yield, say the yield moves to yield y2, what would happen? We move along this straight line and derive this price, P2, sorry, in this P3. That's why but the exact new price would be something else. That's why it says this is only an approximation. This is not the exact price change as a percentage. So basically, it measures this slope of the curve. When the slope is high, what would happen? For a small change, price change would be high. This line 1 and line 2. Okay, assume now we are at this point. If the yield changes to here, now you can see on the red line, the price changes only by a small amount, but on the blue line, it's by a large amount, because the slope of this curve is, this line is higher than the slope of this in terms of absolute terms. Did you get it?
Yeah, in the sense that the M duration is more or less like a forecasting tool, no, where we do a guesstimate on how the rate fluctuation on that specific bond will affect its slope.
Duration is not about the how the slope would change, how the price would change.
price to change, it's basically an indication kind of thing.
Yes, that's why it says it's a measure of sensitivity. For a, say, modified duration, how do we interpret it as? For a 1% change in yield, what is the approximate percentage change in price? Did you get? So say there's a bond, price is 100, and modified duration is 3. Now the yield is 5%. What would happen when yields move to 6%? Yield increased by 1%.
Yeah.
Correct? If the modified duration is 3, what does it mean? For a change in yield by 1%, price of the bond would change by 3%.
Yeah.
Okay. Now what's the new price?
Original price was 100.
Now what's the new? Yes, original price is 100. When the yield is 5%, original price is 100, modified duration is 3. Now the yield moves to Y1, 6%. What would be the new price?
97.
It should be 97, because the price decreased by 3%. How did you know that that is a decrease?
Because the yield increased, no?
Because the yield increased, price decreased. That's why we use generally. Not generally, we don't use that sign, but in the equation, the negative sign indicates that this moves opposite side to the yield change. If this decrease the yield to 4%,
103.
the price moved to 103. But this is, remember, this is only an approximation, because you can see what we measure here is from this. Assume this is 100. Assume this is 100. When the price moves to the next level, what we measure through duration, we measure the price here,
Change.
not here, because we measure that along this line. So we get 103 here, but the exact price would be more than that. Remember, always it is higher than that. Even in this side, if you move to this side, yield increases, actual price is higher than what is predicted through modified duration. Clear?
Yeah. Also, the modified duration is unique for each bond, no?
Yes, because it depends on its coupon.
Duration mainly.
Its coupon, its maturity, and what is the yield to maturity. So different bonds have different coupons, different maturities, and different yields. So the duration measures the sensitivity of a duration of that bond, measures the interest rate sensitivity of that bond. Is it clear now?
Yeah. Thank you very much.
Others, anything else? So in the Excel, so here you might see you get the negative change, because when the interest rate increases, price decreases. So that's why you get negative change here. Indeed, this modified duration, if you put it properly in the equation, we should put a minus sign. But In practice, we don't do that. We just calculate it in absolute terms. And we know that when yield increases, price decreases. When yield decrease, price increase. So therefore,
based on that, we judge
we judge
whether it's plus or minus.
Plus or minus, yes. But there are some equations coming into the picture. We have to use that sign, otherwise you don't get the correct answer. So is it clear? Anything else that you want to know about this? Okay, these are two examples. Again, 1 million, 5% coupon, maturity 4.5 years, but semi-annual. To make it more comparable, we'll make it 5 years, but semi-annual. Okay, fine. The equations are correct. That's what I did. Huh? I just changed few formulas. I want to make sure still this is fine. That's why I put yield to maturity 5. I got par. So my calculations are correct. 5.25. Now you can see this is another key thing you have to remember. Now remember, this is a 5-year maturity bond with 5% semi-annual coupon, and you calculate this you get this Macaulay duration, but see something different here. Okay, I'll delete this equation. What do we do? Time periods, calculate the cash flows, calculate the present value of all cash flows, sum them up. This is the price. That part is clear now. Is it?
Yeah.
Yeah. Then what do we do? To calculate the Macaulay duration, we need time into present value. Time into present value. We do that. So these are time into present value and take the total. Then to calculate the Macaulay duration, what do? We divide this total by price. What do we get? We get 8.96. 8.96 what? The time to maturity is 5 years. Now this duration figure comes as 8.96.
So
Is it okay?
8.
Is it okay or something wrong?
Now, if we will not get this issue if the present value, if we are doing the present value calculation for two semi-annual coupons. No?
Yes, we get this issue because of we consider semi-annual period. So now we have 10 periods. So this gives us 8.96 periods. That means 8.96 semi-annual periods. To avoid that, if we want to get it in years, we have to divide this answer by 2. So basically what I can do, then you get 4.48 years. The answer is in years. So remember, you have to divide that by the coupon frequency. This equation, this is true for this is true, yes, but the way we did this here, it is it won't come. So we have to divide this by 2. And the modified duration, once you get the Macaulay duration, you can do the modified duration in the similar manner, because the y divided by k is adjusted here. It is already there, and it is adjusted. So the modified duration is 4.36. So the one concept I couldn't mention, the duration cannot be more than the maturity period of the bond. If it is a 5-year maturity bond, the duration should be 5 or less than that. Remember, duration should be 5 or less than that. So in the previous in the calculations here, we got 8 point something, means that's why I said this can't be when the duration is, so the maturity is only 5 years. The problem is this Macaulay duration comes in form of coupon periods, 8.9 coupon periods, but in years it's only 4.48. Is it clear? But what would be the duration of a 0 coupon bond? What is the duration of a 0 coupon bond? Go back to the equation. What would happen? All these cash flows, present values in a 0 coupon bond, what are these figures? All these would be in a 0 coupon bond. What is the first coupon payment?
Maturity. At maturity.
Huh?
At maturity.
No, I mean, is there any coupon payments? C1, C2,
No.
C3? No.
No.
All these would be, all these coupons would be 0. You have only this. Okay. Then what is FE? This one? What would be this one? What is this term? That's the price itself. Present value of the future cash flow. Only one cash flow there. This is the present value of this cash flow. This is P. So this comes to 1 over P into N times P. So P and P cancel out. It would become N. So for a 0 coupon bond, duration is same as the time to maturity. That's the extreme. We cannot go beyond that. Duration won't go beyond that. Duration should be O equal to time to maturity. Only time that it comes O equals to time to maturity is when the bond is a 0 coupon bond, or the coupon rate is 0. That is something else that you have to remember and use that knowledge to assess whether your answer is correct. At least some way. There may be it may be a wrong answer, but at least the direction and it's a possible correct answer. If you get a duration figure which is higher than the maturity of the bond, something wrong definitely. That cannot happen. Is it clear? Anything else?
So in a frequency is high, so modified duration is always less than the Macaulay duration, no sir? Is that okay statement?
Modified duration is always less than Macaulay duration,
When the
irrespective
frequency is high.
of the frequency.
Yeah.
That depends only on the yield.
Uh,
When the yield goes up, what would happen? 1 plus y something goes higher. So the number divided by a higher number, you get a lower number. But when y becomes 0, you divide this number by 1. Then it be the same as modified duration. But what would happen when k increases? Y over k decreases. When k increases, frequency increases, y over k increases. Sorry, y over k decreases. When k increases, y over k decreases. That means 1 plus something decrease. This get very close to 1. Then it would be almost same as modified duration. When k increases, in simple terms, when k increases, modified duration is increased to Macaulay duration. When k goes to infinity, y over infinity is 0. So then this become 1. Then it goes to Macaulay duration. So you are taking me to different level. Indeed, even though we use these discrete time levels to discount this, in the at the real backend, what we use is, I think I didn't discuss this even when we discuss about present value, continuous compound. Did we discuss this? I think
no sir.
no. Yes. Instead of discount or the compound these things at discrete levels, we can do that. We compound it at a continuous level. So we do it by using this E and interest rate and time up to maturity. When we use this concept, there's no difference between Macaulay duration and modified duration and Macaulay duration. When we go to the continuous compounding, Macaulay duration and modified duration are the same. So there's no such distinguish in that event. So through that only we can prove that duration of the zero coupon bond is equal to 0. If you do this sort of
Sorry.
calculation, I don't think duration is to 0 for a zero coupon bond. You have to use this continuous compound. But through these equations, you should be able to identify what would happen to these if y increases or k increases or y decreases or k decreases. You need little bit of mathematical knowledge to interpret these relations. Is it clear now? Any questions? If If you don't have any questions, shall we take a break here? I think it's 11:15. Too late.
Yes.
Or shall we continue? What do you need a break or
We'll take a break, no?
need a break? Okay. We'll take a 15 minutes break then. Any questions? If you don't have any questions, let me summarize what we discussed so far. First thing is bond price changes with interest rates. What do you mean by interest rate here? What's the interest rate that we are considering here? It's the yield to maturity or the yield. Bond price changes with the interest rate. Interest rate sensitivity is measured through duration. It can be Macaulay duration or the modified duration. So interest rate sensitivity is measured through duration. What do you mean? For a given interest rate change, what would be the change in the sensitivity? That is measured through the duration. So Macaulay duration. What is the Macaulay duration? It is the weighted average of time. Weights are the present value of cash flows. It's the weighted average of time. Weights are the present value of cash flows. So basically, weight is the present value of high cash flow divided by price. That's the weight. So we multiplied time by this weight and sum them together. We get the Macaulay duration. Remember, we may have to do the adjustment based on the coupon frequency. So how do we, what is the sensitivity then? Simply higher the duration, higher the sensitivity. Other factors affecting duration. Maturity, coupon, and yield to maturity. What is the impact? Higher the maturity, higher the duration. Coupon, higher the coupon, over the ITM over the duration. So then modified duration, which is the duration, Macaulay duration, Macaulay duration divided by 1 plus yield over K. What is K? What is K?
Coupon frequency.
Why is K? What is K?
Coupon frequency.
Coupon frequency. ITM K coupon frequency. How do we interpret the modified duration? Estimate percentage change in price for a 1% change in yield. Modified duration is, how do we interpret it as, approximate percentage change in price for a 1% change in yield. But in the presentation, you might have seen that 100 basis point. What does it mean? 100 basis point is 1. Remember that 100 basis points means 1%, or in decimals, what it is, 1% means 0.01. 100 basis points means 1%, in decimal it's 0.01. If it is the case, what is 1 basis point? 1 basis point is 0.01%, which is equal to 0.00. So this is another jargon that we use in the markets, basis points. Interest rates are quoted in terms of basis points instead of percentage. So you may say 50 basis points. What does it mean? 50 basis points means 0.5%. 100 basis points means 1%. 50 basis points means half of it, 0.5%. 25 basis points means 0.25%. 10 basis points means 0.1%. So likewise, so you should be familiar with these jargons. So in really what we say, modified duration is the percentage change in price for 100 basis point change in yield. 100 basis points means 1% change in yield. So then we discuss how to calculate Macaulay duration. How do we calculate Macaulay duration? and we saw the relationship between maturity coupon and yield to maturity. Then we discuss how to calculate the modified duration and the interpretation. But to make it more clear,
Excuse me, sir. Can you show me the summary sheet first page again? Top. All right. Okay. Thank you, sir.
is it okay now? Shall I switch?
Bottom side, please.
Okay, sir. Thank you. Okay, sir. Thank you.
Then, if the modified duration is interpreted in this way, how do we calculate the percentage change in price for a given change in yield? I just put this minus sign at the beginning. Then you know that if yield increases, price decreases. If yield decreases, then remember, when you put the change in yield, you have to use the sign properly. If you, or you have to remove this negative sign as well. So either way you can do that. If yield change or yield increase, then the change in yield would be positive. If then positive into minus, you will get a negative answer. If the change in yield negative, that means yield decrease, it would be a negative figure. Then you should put the negative figure here. So this is that example. So percentage price change, that's why change in price, what this delta P means is the change in price divided by price. This is the percentage change in price. We can calculate it as modified duration into change in yield into 100. Now remember, how do you substitute figures? So this is an example. Assume a bond has a duration of 7.68. Current price of that bond is 98.09 and the yield change is 0.25 plus yield increase. Then what is the change in price as a percentage? Substitute figures into this equation. Duration 7.68. So even though it says 7.68, it's negative. Definitely it's negative. So by definition and in nature, it's negative. So minus 7.68. Change in yield, positive. So remember, we substitute it as a decimal point, not as a percentage. And multiplied by 100. Together you can consider this as a then as the percentage. Then you have to drop this 100. You can use that way as well, but I'm not recommending that because later there's another equation in that we have to use this in this way. It's better. So then the answer comes as 1.92%. So when the yield changes by 0.25%, the price of the bond will change by 1.92%. Remember, this is not the duration. Duration is 7.68. So even though I said duration, this is the modified duration. So modified duration into change in yield into 100, 1.92%. So this is the percentage change in price that we expect. Again, this is only an approximation. Then what is the change in price? Real change in price. So what we can do, multiply this by price, both sides. Then it will become to this. Change in price equals modified duration into change in yield into 100 into current price. So you can use that. Then the change is 1 point. There's a mistake here. It should be, because this is minus, it should be minus 1.883328. So the new price would be 98.09. The current price minus 1.88. So 96.21. Is it clear? When we know the duration or the modified duration, how do we calculate the new price of a bond when the yield is changed by a given amount? This 0.25% change in yield in basis points, how many basis points? How many basis points here? Going to 5%.
25 basis points.
This is 25 basis points. And remember, in this equation, the change is given. But you may get, now the current yield is something like 7.38. New yield is 3.58. What is the change in yield? What is the change in yield?
basis points.
Sorry?
20 basis points.
20 basis points. But when you do the calculation, remember, you have to put
Negative.
this is negative 0.2%. But when you subtract here, it should be negative 0.002. That is something you have to be careful when you do the calculation. Definitely you will forget to include this minus sign. It is okay if you don't use this negative sign, but whatever the change, then you should be able to interpret whether it's a plus or a negative. Once you use negative here, negative in this equation, negative here, you get a plus sign here. But in this case, this should be minus. In our previous example, it should be minus 1.92, even though I have not written there better. It should be minus 1.92. That's why I have substituted it as minus 1.92. Then you get the minus figure. Then add it, you get the answer. So remember that. Clear? How do we calculate the new price approximation using duration? But as I mentioned earlier, when we do it, it gives you the movement along this line. So whatever this change, 98,099, 9628, 9808 somewhere here, 96 is somewhere here on the line, on this straight line, not on the curvy line. So but still there's a small error. That's why the duration is better when the yield changes are very small. We don't use that duration to calculate the new price or approximate the price when the yield change is 2-3%. Generally, we use that to measure when the yield change is very small. Otherwise, the error part is would be high. You can see here the error is high. But the thing is, the duration measure gives you a very conservative approach, because actual price is always higher than the price that we get through duration. Actual price is always high. So therefore, our valuation is more towards downside. Any question?
Sir, I have a question.
Yes.
How this 0.002 is right? 0.002.
This is the current yield. This is the new yield. What is the yield change?
It's minus 0.2%.
Yes.
Then again, percentage you have. It's
This is in decimal form. This is percentage. So when
percentage.
that's the difference. Correct.
Okay, sir. Okay, sir. Right.
Because
Thank you.
we have to include substitute in decimal place to this equation. You can do that in percentage terms without this 100. That's true, but still you get the same answer as a percentage. But the thing is, there's another equation to come here. Here you can't drop that. If you drop it here, but you need it here, because this is change in yield to square. Without 100, you can't do that. That problem is there. Then we need adjustment into this equation as well. So therefore, better to use this approach. Otherwise, you will have to remember where to use decimal point and where to use percentage point. But I think it's better keep it constant all the time. Substitute it as a decimal point and multiply it by 100. Then chances of error is low.
So if the price change is given by the basis point, how we can decide it's a negative or the positive?
No, the price change, not the price change. Yield change will be given in
Sorry, yield change. Yeah, yield change.
yeah. Then it has to be told whether it's a increase or decrease.
Okay, right, sir. Thank you.
But this can be asked, say, without saying what whether it's an increase or decrease, what is the percentage change that you expect? That can be asked. In that sense, you can say without saying whether it's plus or minus 1.9. Then you need not to put this minus sign here, because whether it's plus or minus, that depends on whether yield increases or decreases. But
It should be both sides same.
both sides same, yes.
Okay.
Both sides same, because it's just the slope of this line. Duration is just the slope of this line, so it's both sides same.
Yes, sir. Yes.
So as a percentage, price would change as 1.92. Whether it's a plus, negative, or whether it's a negative, that depends on the direction of the yield change. Anything else? If not, I'll go back one slide. There's another measure called effective duration. Generally, this is used to evaluate or measure the interest rate sensitivity of a bond with some options like callable options or maybe mortgage-backed securities, where there can be a chance of prepayment or early redemptions. You don't wait until maturity, so therefore you cannot calculate yield to maturity, and for that reason this effective duration is used. But even this one we can use for any other bonds to approximate the duration. Here what we do is simply BV naught is the current price, initial price of the bond, then change in yield, small change in yield, say 25 basis points or 50 basis points or something like that. Generally yes, this is the change in yield. Then what we do, we calculate the price, new price. What would be the new price if the yield increased by this amount, this amount? If the price, or if the yield increased by that amount, price would be low. So this is that, the new price once the yield increases. And again we calculate the new price if the yield decreases by the same amount. If the yield decreases by the same amount, what would be the price? This is that price. It is higher than this, because when yield decrease, price increase. So this figure is higher than this figure. So change that, or take that difference and divide by the price and change in yield into 2, then you get the 2 times yield change. If I draw a small graph here, what do you do? Basically, it's like this. Duration is a straight line of duration. If you use the duration to calculate the price, it would be on a straight line. This is the BV naught. Sorry, not the BV naught. What is on the x-axis? What is on the x-axis? This is yield. Yes. So then what would be the price when we change the yield by, or increase the yield by y plus delta y. So this is the price BV plus delta y. Same way we move other side. This is the new value when we decrease yield. This is the yield minus delta y. What is this difference altogether? What is the yield change from here to here? 2 times delta y, because say this is 10 basis points, this is 10 basis points, it's 20 basis points from here to here, isn't it? Then this is the total yield change. This is the total price change. So we calculate the price change, divide by the total yield change, then it gives for 1 unit what is the 1 unit of yield change, what is the change in price. But to make it as a percentage of the current price, we divide it by BV naught. To make it a percentage, you may multiply this by 100. Did you get it? That's the way of approximating the duration. So you basically you calculate the slope of this line.
So in the numerator, you deduct one value from the other, is it?
Yes, this is the minus.
Okay.
What is this? Basically, we calculate this change, price change. That is here. BV minus delta y is the big figure. BV plus delta y is the small figure. So we calculate the difference. You can take the difference other way around as well. Then definitely you will get the negative sign. That is more appropriate in a way. But we do this for a given change in yield. What is the price change? Then for a 1 unit of yield change, what is the price change as a percentage of the existing price? What is it? So this is called effective duration. But only thing is, to do this, you have to price the bond in 3 different points. You need the price, actual prices. Again, you remember this BV minus delta y, BV plus delta y are actual prices. So not exactly on this line, it's above that, but still we get the approximation. The best thing is make this yield change or change in yield very small, then you get much better approximation. You go further away from the current yield, your approximation is not that good.
So we have to know the prices.
Yes. To calculate the effective duration, you have to know.
If you know the prices, why do you need the duration?
No, just to no. Thing is, you do this sensitivity for a small change, but you can use that figure for another price change as well.
Okay, so you can derive different prices.
Derive different for different yield changes.
Okay.
But yes, that your question is more valid nowadays, because say it's not like a few decades back. Now there are systems you can calculate the new price just by entering. See, if I want to reprice this, what you have to do, I just enter the new yield. That's it. I know the exact price now. So in that way, we can do this, but still measure the sensitivity as a single figure. Then, as a percentage, we know what would be the percentage change. And to make decisions, we can use that. And we know the relationship between coupon, yield, and maturity for the duration. So from risk management perspective, looking at a single number is easy still. That's why still we use this duration. Otherwise, as you said, with this computational power, we don't want to worry about that. Exactly, you can calculate the exact price. So there's another measure. So duration, modified duration, especially modified duration gives you a percentage change in price. It won't give you any rupee amount or dollar amount. So for that, there's another measure called dollar value of a basis point. What does it mean? Dollar value of a basis point mean if the yield change by a basis point. What is a basis point? What is 1 basis point?
1/100th of a percent.
Point 0.01%. This is the value of a basis point. If you convert it into a decimal, it is 0.0001. So the idea of this dollar value of a basis point is if the yield change by 0.01%, what would be the change in value of your bond? Then straight away it gives you a dollar value or a rupee value, whatever the denominated currency. That's the idea. But still we use this modified duration, and this is the equation, nothing else. This is the equation. Only thing is this yield change is given, fixed. We know that. That's why this point comes here, and the bond value, modified duration into this, and the bond value. Better you put 100 as well to make it complete, because in this equation you had 100 and the price. So by looking at this, we know if yield change by 10 basis points, we'll gain or we'll lose this much of rupees approximately. And since it's a for a 1 basis points, it gives you a very close figure. So this gives you an idea of about your PNL. What would be the impact on your PNL in rupee terms? That's the use of this DV/1. Is it clear how to calculate DV/1 and what it is? Duration calculates the percentage change for a 100 basis point or a 1% change in yield. Here, the same thing, but in absolute figures for a change in 0.01% of yield change, very small yield change. Okay.
So why do we multiply that by 100, that dollar value?
So same concept here. So this is the equation that we have to use. Change in price
The
to get,
other one,
yes,
dollar value.
we are using the same equation. Instead of delta y, we have put the change in yield in decimal points. Point 0.0001. So therefore, we need it here. We put the bond value here.
So, excuse me, what
See,
is the reason for using 0.001 here?
that's the
For
change in
this,
yield. This is the change in yield.
the
That's
other
the
one, DV calculation.
that's the definition. The dollar value of a basis point. What is a basis point? 0.0001. That's what we use. This is change in yield. The same equation, we specify the change in yield, make it constant, and see what would be the change, and given a specific name called dollar value of a point. Is it clear now? Is it clear?
So we are using this equation only to find out dollar value.
Yes.
Can't be used for Sri Lankan rupee.
No. That's the definition. They call it dollar value of basis points. That's why I mentioned the bond value. If it is in rupees, we get the change in rupee value. Whatever the currency, it doesn't matter. Generally, we call it dollar value. That's the definition. The name you given, even in rupee terms, your balance sheet, or not your balance sheet, sorry, in your report, you will report it as DVO1. Report it as DVO1, but your figures are in rupees. This is like a name given. It's any currency. Is it clear? Are you clear about it? Anything else? If we use this same equation, same bond, what would be the dollar value of 1 basis point? $7.668. Yes, 7.68 into 0.001 into 100 into 98. Point 0.9. This is the DVO1, but this is 98.09. Remember, this is for a face value of 100. If you have a portfolio of 10 million with 10 million face value, then you have to multiply 10 million into this one divided by 100. If you use this figure here, bond value, then you need not to use this 100. So therefore, whenever you use this equation, you have to be very careful. What are the things that you use? If you go by these, what will be the figure? Basically, for a 25 basis points, it's 1.88. So 1.88 divided by 25, you should get the answer. Any other question? Because I'm not going to move into the next topic. Now we don't have time to discuss about convexity. If you have any questions, please. It seems you don't have any questions. If not, shall we stop here?
So coming Sunday is the deadline for the assignment, no?
Yes. That's good that you remember. Oh, remind me. Yes, I just remember that. Next week is the deadline. So before midnight 12, upload your answers. Okay.
So where we have to upload, so there is not an option. We can't see the option there.
No, there should be you should be in the assignment when you go to the classroom. You have this assignment.
Yes.
In that there should be a link to upload. This is my view. This won't work for you. If someone can help him.
Or else will Mr.
I think you may get something like this mail.
Yeah, this is coming. Yeah.
Yes, then
So inside that there is an option called add or create. You can attach the file.
Yes, there is option.
yeah, here.
No, in the assignment there is an option under the file. There is an option.
Can you see my eye in here?
It's I think it is not in.
I think yes, it's not in my my view. In your view, it should be. Is it
Yeah,
here?
in our screens there, sir.
In your screen, which area? Is it here?
Under the file, there is an option called
You just
add
have
or
to click
create.
on that and then go to the next view.
You have to click the add. Under that, you can attach the file.
Attach the file. Okay.
Okay, thank you. So PDF format is not an issue. We can upload with either PDF or Word.
PDF is okay, but it's not it should not be a scan PDF. That means you scan a document and convert it into a PDF. It should not be that way. Word
Okay.
document, convert it into a PDF. You can save it as a PDF, no?
Okay, sir. Okay.
Then upload it. If you scan and upload, it won't work.
Thank you.
Okay, thanks. Anything else? So I don't know. Now there was a 2 turn in and now it turned into 1. I think someone has already submitted. Okay, anything else? If you don't have any other questions, shall we stop? So you might see now we are moving into much more technical things. So to understand that, you need the prior knowledge, refreshed knowledge. So that's why I always asking, before you come to the class, please refresh what we did last week or previous few weeks. Now, next week we are going to discuss about this convexity. That is just to make it more accurate. So when we use the duration, it's going along this straight line. To minimize this error, we can do a small another correction. It will bring that price closer to the correct or exact price. But again, it's not 100% accurate. Still there will be error, but you will get more accurate thing. So we are doing that part in mathematical terms. Today what we discuss about the first derivative of the price yield relationship, first derivative of this equation, that is duration. Tomorrow we are going to discuss about the second derivative, the convexity. Not tomorrow, next week. So better you come up with a refresh knowledge on duration. Then you might see we are going to do calculation for a yield change with the duration effect and convexity effect, and try to approximate the price as much as close to the actual one. That's the way forward. So to do that, better refresh your knowledge on the things that we discussed today and last week at least. So if you don't have any questions, we can stop now.
Sir, I have a small question.
Yes.
Sir, so what is the use of dollar value was basic point?
That it will give you a sort of PNL. If 0.01% or the 1 basis point, what would be your profit in rupee terms? If yield increased by the same amount, what would be your profit or the loss? Rather, it's a loss in rupee terms. Without having as a percentage for 1% yield change, 4% duration, that means for a 1% yield change, your gain or loss would be 4%. Then what is 4%? Then you have to multiply again by the price and to get the percentage change. To avoid that, and for a very small change, for a 1 basis point, what would be the change in the price in terms of relevant currency, whether it's dollar or rupee or Indian rupee or Japanese yen, whatever the currency. That's the purpose of that. And beyond that, then there are other risk matrices that we calculate to measure the risk of fixed income securities and especially risk of portfolios when we calculate that sort of measures, key rate duration, and maybe for a portfolio tracking error, we use those, but we are not going to go into that detail. It would be too much for you.
So I didn't understand that why we multiply 100.
Sorry?
That we multiply that in 100. That we
So basically, if you don't use that 100, what would happen? Try it with few numbers. So what this gives, this equation, it gives the change in price. That means like here 1.88 rupees, this is 1.88 rupees but in this case for a 0.25 change in yield. But what you need is for a 0.01% change in yield. So what we do, instead of delta y, we straight away fix that 0.0001 figure. Here we put, instead of 0.0025, we substitute 0.0001. Then what is this figure? It comes as a percentage. Then you have to multiply this by this price. Then you get it. But only thing is, if you don't, so if you don't use this 100 there, then you have to consider this without as a percentage, because this is a percentage. 1.92 is a percentage. In equation you have to write it as 1.92 divided by 100. Okay, let's take this into the Excel. 1.92, 98.09. We'll go to a new sheet. 1.98 and 98.09. What you get if I just multiply these two figures? 194 something, but see it's only 1.88. 198, sorry, 1.92, 188. But this is not 1.92. This is a percentage. 1.92%. 1.92%. You can see now you got it. 1.88. So why? What we did, 1.98 into 98.09 divided by 100. Sorry, 1.92. You get the same figure. So whenever you use percentage, remember there's a hidden 100. Divide by 100. To remove that effect, you need this 100, and it may be another cause of we are substituting change in yield as a decimal, not as a percentage. That's why we need this 100. It's about handling percentages and decimal figures. Just think about it. When you use a percentage and when you use it as a decimal, what you have to do?
Okay, so that MD is used as a percentage, that's why.
Yes, we use this as a percentage.
MD, modified duration.
Modified duration is also a percentage. Yes.
Oh, okay.
We interpret it as a percentage, or basically it's a percentage. 7.68 is a percentage.
Okay, thank you.
Okay. Anything else? Yes. Don't be afraid to ask questions, because it's your question. That's the gray area for you, not for others. You have to be clear on that. That's good. Nobody will ask your question. Even though they have the same question, they won't ask. So if whenever you have a question, ask. That will help others as well. Okay, shall we stop then, if you don't have any other questions?
Okay, so thank you very much.
Okay, thank you.